Excuse me. I'm sorry. I was just in deep meditation on the dividend discount models. Right. Okay. Well, anyway, let's get started on slide 21 with my favorite version of the dividend discount model, and that is the discounted cash flow model. In this model, we take the value of the stock to be the present value of all expected future annual cash flows. Now, okay, remember we told you, 99-cent calculator, don't worry about the math, but this is the model in its purest state. We take the cash flow from year number 1 and divide that by 1 plus our discount rate, our required rate of return. We then take the cash flow in year number 2 and divide that by 1 plus the discount rate squared. And then the cash flow in year number 3, 1 plus rate to the third power. We do that on to however many years we want to do it. And I warned you, I promised you we would not use exponentiation, and we will, of course, hold to that promise. But we just wanted to show you what it looks like in its purest state. So let's say we have a company that's going to pay us 3 annual dividends of $10 per share, and then no more dividends. Okay, we'll go 3 years out. If our required rate of return is equal to 7%, well then, if we were to use an exponential calculator, it would be 10 divided by $10 for the first year divided by 1.07, and then $10 divided by 1.07 to the second power squared. And then $10 divided by 1.07 to the third power, 1.07 times 1.07 times 1.07. And if we were to add all that up, don't bother, I told you, 99-cent calculator. It turns out that this company would be worth to us $26.24. But how often do companies pay 3 annual dividends and then promptly go out of business? Plus, we keep using this term present value. What does present value actually mean anyway? Slide 22. Slide 22. Come on, let's go to slide 22. I don't know why I have so much problem with this technology. What is present value? Well, again, it's one of those terms that gets in the way of the concept and makes it difficult for people to understand because they hear these terms, they don't understand what they mean, but then when they finally understand what they mean, oh, I understand. The present value is the value today of a lump sum or a series of payments to be received at some future date. It's the opposite of future value, what we mathematicians call the inverse operation. Did you work on the optional future value calculations back in chapter 1? You didn't have to. We just showed you with examples of mutual funds how compounding into the future works. Well, what we're going to do is we're going to do the opposite. We're going to discount from the future back to the present. I know it sounds kind of dumb, but get used to it because that's the term we use. The future value, for example, of $10,000 in 10 years at 10% is equal to $25,940. So if we were to get $10,000, put it in an investment, and get 10% over 10 years, we'd have the future value of $25,940. But what if we said, hey, in 10 years, we're going to get $25,940, and we require or we expect a return of 10%. Well, then the present value, the inverse of that $25,940 in 10 years, today in the present would be worth to us $10,000. And if you want to look at the formulas, they're basically the inverse of each other. Here's the future value formula, and there's the present value. You just put 1 divided by that. They're just 2 sides of the same coin. In finance, present values tells us what the future value is worth today. So, would you rather have $10,000 today or $25,940 in 10 years? Well, if your required rate of return were 10%, they are the same. You wouldn't care. You'd take the $10,000 today or the $25,940 in 10 years. And again, we call it discounting. Get used to it. Slide 23. Did the formula for the model scare you? See what the exponential numbers in the denominator? This formula has the present value calculation built into it. We mere mortals simply use the present value tables, or when we get used to it, we use the spreadsheet, to discount the future annual cash flows. Just as those of you who did it in Chapter 1 or did it in Business 121, Principles of Money Management, we use the future value tables. And so the formula changes from an exponential formula to a simple multiplication. We take the cash flow in year number 1 times the present value multiplier for year number 1, plus the cash flow for year number 2 times the present value multiplier for year number 2, plus the cash flow for year number 3 times the present value multiplier for year number 3, and for however many years we're going to do it. I know it sounds a little scary, but it's actually very easy once you do it a few times, so stick with us. Present value multiplier, PVM, is the present value multiplier for year number 1. PVM2 is the present value multiplier for year number 2, etc. We use the present value multipliers to discount the future cash flows back to the present. Again, I know the verbiage is, the words are weird, but get used to them. Slide number 23. Let's do the same example over again. We're going to use the present value multipliers from the present value table on the class website. Now, it's a good idea to print this puppy out. Okay, it's a good idea to print him out. I got him on the, or her, or whatever. I got it on the screen in a minute. We're going to do 3 annual dividends of $10 per share. Again, required rate of return, the discount rate is 7%. So what do? For $10 in the first year, we multiply it times the present value, which is 0.935. Now, where do we get that? I'm going to go to the present value table. Here it is. Print it out. We go across the 7% down 1 year. There's the 0.935. Are you with me? There it is. That's the present value multiplier. So we take the $10 in year number 1 and we multiply it times 0.935. So that means today, $10 that we get in 1 year, if we have a 7% rate of return, required rate of return, expected, desired, is worth to us today $9.35. Would you rather have $10 a year from now or $9.35? Well, if your required rate of return is 7%, you don't care. They are equivalent. The second year, it's 0.873. Where did we get it? From the table. Go down to year number 2, 0.873. Did I do that right? Sometimes I mess up, so watch me. Yep, 0.873. So $10 times 0.873 is $8.73. Would you rather have $8.73 today or $10 in 2 years? If your required rate of return is 7%, they are the same. And we do the same thing for year number 3, 0.816. Let's make sure I got it right. Go over to 7%, down to year number 3, 0.816. I did it right. Yippee for me. So $8.16. So if we add those 3 numbers up, those 3 present values, we get the present value of 3 payments of $10 each for the next 3 years at 7%. At 7%, $10 in 1 year is worth $9.35. In 2 years, $8.73. In 3 years, $8.16 today. And then the sum of the present values of the future annual dividend cash flows equals our perceived value of the stock. Is this making sense, folks? I know the words are funny, but all we're doing is we're saying, look, if we're going to get $10 next year, $10 2 years from now, $10 3 years from now, it's not worth $30 unless our discount rate is 0%. You understand? We know this intuitively. We know that $1 today is worth more than $1 in the future because of the time value of money. Right. So next slide. Here is a little graphic of the present value multipliers, which come from the present value table on the class website. And there are the three multipliers that we saw: 0.935, 0.83873, 0.816. And there's the little formula. Dividend in year number one times the present value multiplier for year number one. Dividend in year number two times the present value multiplier for year number two. Dividend for year number three times the present value multiplier for year number three. So if you're worried about the math, it's not math, it's arithmetic, and it's really very straightforward. It's just tedious because you have to go, look up the values and then multiply them and then add them all up. Adding them all together gives us the present value of the future stream of the dividend payments. So we know we're going to get $30 over the next 3 years, but today at 7%, those three payments of $30 are equal to $26.24. That's the present value of the future stream of dividend payments. Cool. So, slide number 26. Our example did not take into account that the stock will still have worth at the end of the 3 years. To make the model more useful, we simply add our predicted market price of the stock at the end of the 3 years. We treat the price of the stock at the end of the 3 years as a future cash flow. Well, because we can sell it, right? We don't have to hang on to it. We can take our three dividend payments of $10 each, and then sell the stock at the end of 3 years. So we treat that as a cash flow. So then the formula becomes the value of the stock is the present value of the future dividends plus the present value of the price of the stock when we plan to sell. So we just use the present value multiplier for not only the dividends, but also for the expected price of the stock. And as with the other dividend discount models, this model is very sensitive to our estimates and our choice of required rate of return, and hence the results will vary widely depending on our required rate of return. Slide number 27. Let's say the current price of the stock is $125. We predict the market price of the stock to be $135 at the end of the 3 years. So what we're going to do is make a little table here just to make it a little easier. $10 in the year number one times the multiplier for year number one. $10 in year number two times the multiplier for year number two. Year number two. And the dividend for year number three times the multiplier for year number three. But then we're also in year number three going to use the expected price of the stock of $135. And notice that the present value multiplier is the same. This is where people sometimes mess up. They use the present value multiplier for the next year. No. We're getting the dividend and we're expecting the stock, the price to be in the third year. We're getting the dividend in the third year and we're assuming that we could sell the stock or it'll be worth $135 in the third year. That's why these two are the same. That's why we highlighted them, just so you don't get confused, because it's very easy to go to the next line just because you think, I got to go to the next line. No. So you do all those calculations, $9.35, $8.73, $8.16, but then we take the 135 times the same present value multiplier and you get $110.16. Add those four numbers up and we believe the stock is worth $136.40. Cool. The current market price is $125. So the model is pointing us to this stock. It's saying this is a potentially good investment for us at 7%. Now, do we, yes, buy it? No, of course not. We've got to do a whole lot more research. We've got to look at their competitors. We've got to look at their suppliers, their customers, the industry as a whole. We got a lot of work to do. We got to look at the annual reports, and we're going to learn how to do some financial analysis on ratios in the next chapter. So this is just pointing us in the direction of stocks that may be potentially good investments for us. So Here's an example of a company called Pretzels Unlimited, PU symbol, is currently selling for $22 per share. And it looks like they've been paying dividends for many years, and it looks like they're going to pay $2 per share in 2023. They expect to increase their dividends to $2.20 in 2024, $2.30 in 2025, $2.30 in 2026. And so we're thinking we'll be selling these stock at the end of 2026, and we expect the price to be $27 per share at that time. Our discount rate, our required rate of return, is 12%. So let's go back to the formula. The value of the stock today, the present value of the stock is equal to the present value of the future dividends that we receive over the next 4 years, and the present value of the price of the stock when you plan to sell. So $2 times the present value multiplier at 12%. We got to go find that. Let's go to 12%. There it is, 0.893. Make sure you can do that. It's not hard. Okay. And then $2.20 times the present value of 0.797. That's why it's a good idea to print this thing out, right? So let's go to year number 2. I did it right, 0.797. Can you remember 0.712 and 0.636? I'll see if we can remember that, okay? And let's see if we get that right. And the year number 3, 0.712. Yeah, we got it right. And the year number 4, 636. Was that right? I think it was. Yeah, 0.636. Yeah. Now, here's the tricky part. Those were the dividends. What do we do with the price of the stock? Notice we use the exact same multiplier because we assume we're going to be selling the stock in the same year as the last dividend, year number 4. So we use the same present value multiplier. Don't go to the next year, okay? Make sure you don't trip up on that. It's very easy to trip up on that. So we do all those calculations. They're not hard, folks. That's why we got our 99-cent calculator. And we come up with a number kind of close to $23.81. Now, please don't worry about precision. We are trying our best not to be precise. We're simply putting our finger up in the air and seeing which way the wind is blowing. But the model is saying, you know what? We think if you get these numbers, if you get these future cash flows, this stock is actually worth $23.81. And with a market price of $22, this is potentially a good investment for us. It warrants our further exploration. Make sense? I think so. It doesn't always work, folks, but it does work a lot, especially with boring companies like companies that make pretzels for almost 100 years. Slide number 29. Now, we're going to put it in table form because I think it's much easier to calculate. I think it's much easier to visualize. But notice, here's that weird little thing at the end. In the same year, the last year, we do the calculation for the dividend in the year number, in this case 4, 2026, and the expected price of the stock that we could sell as a cash flow for $27. So again, notice that the present value multiplier for the dividend and the expected price of the stock in year number 4 are the same because we're receiving both of these cash flows in our 4th year. All right, so I think this format is easier to comprehend and calculate. Do you? I think so. But let's take it one step further. Let's simplify it a bit. Let's take that last year and add the two cash flows together. Well, it reduces the number of manual calculations that we have to do. We get the same result, right? But now we add the dividend in year number 4, 2026, plus the expected price of the stock, 27, and we get $29.30, and we multiply it times the present value multiplier, and these are the results. Add them all up, and we get the same result, $23.81. Adding the dividend and the stock price in the last year saves us a couple of manual calculations, but more importantly, it also allows us to use a special spreadsheet function to calculate the internal rate of return. It's a fancy thing that you learn in an upper class finance or investments class or a graduate level finance investment class. But it's so cool, and we have a spreadsheet that does it for us. The internal rate of return is a measure of what rate of return we expect to get from a series of cash flows. We need to include the positive cash flows, which we've been dealing with, but we also have to include the negative cash flows, or it doesn't work, right? Someday, when you take an upper level or a graduate finance or investment class, you will learn how to manually compute internal rate of return. And hopefully, you will not have a sadistic professor who will require you to calculate it manually more than once. It's really not that hard. It just is very, very time consuming and tedious. We, on the other hand, are going to simply enter the numbers into a spreadsheet formula and press the enter key, okay? Because, I mean, that's why they have computers, to do manual, tedious calculations that would take us a long time and are not really fun. In other words, we required a 12% rate of return from Pretzels Unlimited. But what do our numbers tell us will be our expected rate of return? If indeed we get these next 4 dividends and the stock goes up to $27, what kind of rate of return are we actually going to get? Slide 32. Here's the formula. Now, spreadsheets are a wonderful thing, folks. If you hate numbers, they're even better, because once you start using, you'll go, this thing does the calculations for me. Yippee. And we teach it, so think about it. The spreadsheet formula is internal rate of return, IRR. You got to put a little equal sign there. And then the values that we want to use, both cash inflows and outflows. You got to look at both the positive cash flows coming in and the negative cash flows going out. And then the optional argument here, the optional second thing to put in, is what you believe it is. You can leave it at 0 and it'll try to figure out on its own, if that makes any sense. So values is the block of cells containing all the cash flows, both positive and negative, and the approximate rate of return is our guess as to what the internal rate of return will be. Again, leave it 0 and it'll try its best to do it. Now, why is that? Because sometimes the internal rate of return gives you aberrant results. Like that word aberrant. Sometimes it doesn't work. Or sometimes you get 2 internal rate of return. It can be very, very strange. And so if it can't figure it out, it'll come back and say, sorry, I screwed up. I can't do it. But here we are. Here's the same table, right? With the 4 cash inflows. But we also have to include the initial outlay. How much did we have to spend at time 0? In other words, today. What did we have to spend today to get these cash flows in the next 4 years? We had to spend $22. So you have to include that in the formula. And the formula becomes, and this is column A, and this is column B, and this is row 1 and 2 and 3 and 4. It's kind of like bingo, folks. It's pretty straightforward. So our formula is internal rate of return, B12 colon B6. I'm sorry, B2, not B12. B12 is a vitamin, right? So it's B2. B2, here's B2, down to B6. Don't do B7 because that'll make things, screw things up again. So B2, B3, B4, B5, B6. And then I put in 12%, 0.12. But again, we could have left it 0 and it would have figured it out. And what does it tell us? Dun, da, da, da. It's saying, look, if you indeed pay $22 for this stock today and get these 4 cash flows over the next 4 years, you're actually going to return 14.51%. Cool? I think so. I think, yes, this is very, very cool. Now, you can, in the face-to-face class, we would jump on over to the spreadsheet. Go ahead, take a look at it, pause the presentation, and take a look at it, and realize that you can actually play with the numbers, right? You can actually change the dividends and the expected price and see what kind of other results you get. Cool. Okay, so does that make sense? Does that make sense? Stop before we start. Let's take a little break there. Make sure we understand. Do these calculations right now in the face-to-face class. If we were doing a face-to-face class, we would run to the worksheet number 1, and maybe worksheet number 2 at the same time, and do the next problem, which is the discounted cash flow model. And I like to create a table that looks just like this because I just think it's a whole lot easier to do in my mind then. Okay, slide number 33. Example number 3. Genes are us. You know what the one chromosome said to the other chromosome? Do these genes make me look fat? Do these genes? See what you're missing in the face-to-face class? Is currently selling for $21 per share. They pay no dividends. They've been losing money for a long time trying to create this fabulous drug that's going to cure baldness or whatever. We believe that Genes R Us will sell for around $50 in 5 years. Our required rate of return is 13%. How can we determine if this is a potentially good investment? Well, with no dividends, which model can we use? We can't use the Gordon growth model. That tells us that the stock is worth nothing. But the discounted cash flow model can still be used. Because remember, the formula is the value of the stock equals the present value of the future dividends plus the present value of the price of the stock when we plan to sell. Well, there's no dividends, so the left side, 0 times anything is 0. So the present value of the dividends is 0 because we're not getting any. But $50 in 5 years discounted at 13%. And where did we get that number? We went across to 13% down 5 years. Can't see the years on the left side, sorry, but you can see if you print it out. Go across to 13% down 5 years. There's the present value multiplier. Multiply the $50 times 0.543, and it tells us that the stock today is worth $27.15. Remember, the price is $21. So the model is saying, you know what? If indeed this stock is worth $50 in 5 years, it's worth today $27.15. It's a potentially good investment. But what can you say? What can we surmise about the risk versus reward profile of Genes R Us as compared to Pretzels Unlimited? Right. See, if you've been paying attention, you'll say, oh my goodness, a company that's been making pretzels for 100 years is a whole lot less risky than a company that hasn't created the drug yet and might never actually create the drug because it turns out the drug turns your liver into pate or whatever. It just, you see the difference? This is a very speculative stock. Remember speculative issue, speculative stock from chapter 3. Whereas Pretzels Unlimited is a more income-oriented stock. Boring. Right. This stock might be worth $50 in 5 years. It might be worth 50 cents. This is the kind of stock that can turn $1,000 into $20, $30, $40,000, or it can turn it into a few bucks. And so now you see how incredibly powerful you are now. You can look at a company from its cash flow perspective and identify those companies that are much more risky, speculative, means gambling, than those companies that are boring, income-oriented, equity income. Cool? I think so. Slide 34. Let's apply the two spreadsheets to Genes R Us. Current market price is $21. We expect the stock price in 5 years to be $50. It pays no dividends. So if we used the original spreadsheet, we put 0, 0, 0, 0, and then $50. And then of course that's all worth 0 for the. Where's that 27? I got a mistake there. That 27 doesn't belong there. I'll get rid of it. I apologize. I got to get rid of that. How did I make that mess up? So $50 times 0.47 is $27.15. It's actually very easy. The calculation's easy. You multiply the future price, what you believe the future price is, times the present value multiplier for however many years at whatever percent. Now, um, the internal rate of return, no, we don't even need the first 4 years. We could just do the last year, right? We don't even need the first 4 years. But if you do the internal rate of return, you have to have all the years. Even if they are zero, we still need to put them in because it'll mess it up like crazy. So put in the initial outflow of $21, and then you get zero dividends for the first 4 years. And then the price of the stock, we believe, should be $50. We run the internal rate of return calculation from B2. This is B1, there's A. B2, B3, B4, B5, B6, B7. And we put in 13%. We could have left it zero. And we wind up with an internal rate of return of almost 19%. In other words, the model is telling us if you indeed get $50, if the stock does go to 50 from 21, you're going to get almost 19% a year, which is pretty darn good, folks. Pretty darn good and pretty hard to believe. But it happens. It happens with these very speculative companies that sometimes it actually works out and sometimes you hit the jackpot, and it never worked for me. Anyway, they all went up, folks. They all did really well, and then they all crashed and burned because the technology didn't turn out like it was supposed to. Look, you cannot leave Business 123 without knowing how to compute the Gordon growth model and the discounted cash flow model. If you don't, it is very bad for my self-esteem. It just crushes me because you didn't learn it. And guess what? They're going to be on exam number 2. They're going to be on exam number 3. They're going to be on exam number 4. They're going to be on the final exam. So you might as well learn them now. Study the worksheets, their answer keys, commentaries. Contact me. We want you to be awesome. We want you to be the best stock pickers the world has ever seen. So please do it. Please, pretty please. Please. Slide number 35. Folks, these are just a few of the dozens of models out there. The residual income model, which is basically the same as the Gordon growth model, uses earnings. Free cash flow uses cash flow. Remember depreciation? Oh, we haven't gotten there yet. Chapter 5, you're going to see that earnings and cash flow are not exactly the same. The price ratio models, which I don't think are very good at all, but they use the various price ratios, estimated growth rates, and we'll talk about those in the next chapter. Look, there are many valuation models. You have the rest of your investing career to explore them. Please contact me when you find one that is better than the discounted cash flow model for dividend-producing companies, because I'd love to see something better. I love the discounted cash flow model. One of the best models for growth stocks is the betterinvesting.org stock selection guide. And we will take a look at it. We'll take a look at it in the book. It's in the appendix, so you can look at the appendix. Or we usually get somebody from Better Investing, which is an awesome group, an awesome, fabulous group that's been around since 1951 and helping investors be prudent, long-term oriented, buy and hold investors. But they are more growth oriented. They're not as dividend oriented as I am. So remember, you're going to see chocolate and vanilla, and hopefully see strawberry too. So you understand? You have the rest of your life. That's the best. I think the best thing about investing is that you'll never stop learning. And I think that's just the best thing available. I mean, who wants to stop learning? I don't know. Maybe some people. Slide 36. Okay, Payano. This is all great, but just where are we supposed to get all this historical information anyway? And just who decides what next year's earnings or dividends per share, the dividend growth rate, etc. are going to be, let alone the expected price of the stock in 3 to 5 years? Well, before the internet, this information was not readily available. You would ask your broker for it, or you would use one of the trusted information sources available in the securities industry, and traditionally the most respected source was the Value Line. And when we come back, dear students, we will see that we don't even have to decide. We can do our own calculations, or we can simply steal from the value line. I think this is wonderful. I think this is fabulous. And dear students, you are now official investment gurus. Never again will you look at an investment just without understanding anything about it. You'll say, "What can it return to me in future cash flows?" And I can put a value. I can put a present value on that. Realizing that our predictions are just that. They're predictions. We know that 99.9% of the chance, 99.99% of the chance, they're not going to be right, but they point us to investments that should do well over the long term and have a much lower probability of cracking, falling, and dissolving into a pool of tears. So when we come back, we'll start here with the value line. Oh boy, this is so much fun, dear investment gurus. I'm so proud of you.